Hello guys. I got some questions. They are all all related, which is what if the market begin to crash and some industries begin to go down, and it means there is a feeling of a downtrend coming. Okay, so what you should do in order to trade. So as I have explained in other videos, for what we call indexes, like an index, if it's falling down, this index, is it a major index, like for example the Dow Jones or S&P 500 or the Russell 2000, like a general one, or it could be any industry, okay, and you see that it's going down, and if you buy the ETF, you will lose money, because the ETF, it means the ETF that attracts the index is going down because it attracts it, so they do the same thing. Now you can search for an inverse ETF. I have explained this in many videos before, so please check my channel. Just 1 week or two, you will find these videos. So what is it in an inverse ETF? It means if an ETF is going down, like the S&P 500 ETF, which is called the SPY, SPY, this is the ETF that attracts the index 500, S&P 500. Now if it's going down, there is another index, there is another ETF that it is going the opposite direction. It means if you buy it, you can make money when the ETF SPY, which is S&P 500, when it's going down, if you buy this ETF, which is called SH, okay, if you buy it, it will be going up and you can make money. So this is one thing you can do. You should search. This is typically for indexes. Okay, you find index, find what is the ETF that attracts the index, and then when you find that, try to see an inverse ETF that goes the opposite direction. Okay, it needs some search, and just try to see few of them and try to track them. If you want to trade like this, you do it. Okay, now because the market is going down, so if you buy like an index, it's going down and you lose money. Now you can go to option puts. Okay, so if any stock is going down, any index is going down, whatever is going down, okay, you buy this put, which is going down also, but you will be making money. But understand that the options, calls and puts, whatever money is put there, if there is a change of the direction, you will be losing a lot of money, because these are very, very volatile vehicle of investment, like puts and calls. Okay, so this is a second thing that you can do. Now the third thing is you can short stocks, but for me, this is just my opinion, try not to use shorting stocks in swing trading. What does it mean? It means don't hold the what we call the shorting from one day to another day to the other day. Now why is that? Because believe it or not, if there is a major good news to that stock and that stock goes like a gap up, you will be losing too much money, especially penny stocks that are very that are very manipulated. and there is a very large volatility. So if you want to short stock, whatever is the stock, big or small, my opinion is try always to do it in day trading. Okay, because at least if you see something wrong, you can buy back, or what we call cover back, buy the shares back, and then you exit the trade and you are okay without big loss. This is if you get scared. But there are some people who try to short the stock and stay many days or many weeks, and he sees a lot of money coming. But believe me, if one day something happened good to this company, or you will never know news. Okay, news can come at any time, and if it is good news, you will be trapped and you will be losing too much money. Not just your money, but you can be in debt, and it is a very dangerous thing. So don't play with shorting stocks, and try to understand the mechanic. Don't say that the stock is always going $1 to down like this. In the news, if good news comes, the stock can jump with $20, $60, $100. You will never know. And don't trust. Okay, don't trust that things will be going your way. The market is not you. The market will decide by his own way, not your way. That's why a lot of people are always surprised. Why this happened? Why this happened? Why I short the stock today? Tomorrow we have a gap up. Why? There is no earnings. There is no this. Okay? You begin complaining about the market and arguing with the market about the price. The price is decided by the market. It's not you. So don't worry. Don't bother yourself complaining to the market, because the market is whatever price you find is the market. So you should accept it. That's it. Don't complain. If you don't want to complain, don't buy stocks or don't short stocks. Why you buy and then you complain? Okay? Now, these are the three major things, as I told you. Either you do an inverse ETF for indexes, ETFs, or you can just buy puts. It means the market is going down, you go and buy a put contract, which is option. You buy one contract to wherever you want, and if the market is going down, you'll be making money, and then you sell it and then you make money. Or you can short in day trading. Okay, shorting in day trading, it means in the morning or at midday or the afternoon. If you find an opportunity to short the stock, a few minutes or half an hour or 1 hour or two, it doesn't matter. So, and you can make money. That's a good thing, because you understand that most of the stocks, when there is a major crash, they begin to fall down, and from the morning you will be seeing that the market is going down. It's an opportunity to make money with shorting. Now, if you don't know shorting, try to see training level 11. Training level 11, how to sell short a stock. It gives you a lot of information how to do it. It gives you the mechanic. It gives you the risk, which is the most important thing to understand. Before you short any stock, you should understand the risk. If you don't understand the risk, you will lose a lot of money. Maybe you will be in debt. So you should understand what you are doing. When you understand and you want to do the trade, at least you have an idea that it might happen this or that. Okay? For those people who have never heard about options like calls and puts and why we use them, please try to check my training, which is level 14. Understand options, calls and puts. It's just training basics to understand what you are doing, why you do calls, why you do puts, and what's the risk that you can have. okay, in doing this vehicle of investment. Okay, for stocks, as I told you, you can check the ETFs, the inverse ETFs, and when the index is going down, you buy the inverse ETFs and your ETF is going up. So you are making money and the market is going down. And this is what a lot of investors, they do in these terms of volatility, or when the market is crashing. They use puts, or they use this inverse thing, or they short if they are day traders. Okay, so thank you very much for watching this video. Please, if you have more questions or you have more ways to do in the market, please share with us, and I would be happy to discuss this subject with anyone, either who knows or who doesn't know. And if you have a private message, please send me a private message. Always you can find my email on the top of the description, and send me an email. Thank you very much and have a nice night.